Welcome back, everyone. So today we'll be having another episode on how I actually identify a high quality company. So there are several factors as well as criteria that we will be going through in this video and to see whether or not if this company is actually a good quality and have good business model, making money, and in the long run, the price of the company will actually go up, maybe even 10x. Who knows, right? So without further ado, let's get right into it. So how I actually identify a good quality and high quality company is by first to look at their revenue. I would like to see a increasing revenue. First of all, is going to be their annual revenue to have a increasing trend. So if I want to have a fast entry on a specific company or a stock, I would actually use a quarterly data. So this quarterly data for my criteria or my perspective is that I need to see a consecutive increasing of 4 quarter datas, which means that 4 consecutive increasing of the revenue in or before I can actually purchase or that investment tools. So increasing revenue actually indicates that the company is actually generating more sales, more growth in terms of selling, and indicating they have strong competitive advantage, as well as the market is in high demand of the servicing or the products that the company provides, which actually generates them high revenue and increasing revenue as well. So with increasing revenue, they will be having great profitability, of course, as well as enable the reinvestments. So the second is going to be the net income. So after looking at the revenue, so the revenue is actually just the sales, but after deducting all the operating costs, all the debts, the only net income is going to be the indicator that tells you whether or not if this company is actually making money and making their profits. So based on net income, I will also look at their annual net income. I would like to see a increasing trends and also shows that the company is actually growing their profits and having a working business model. And since we talk about the revenue is just the sales, we have to deduct some of the operating costs as well as other debts. So meaning that if the company is being able to generate a high net income with the probability as well as the stability in terms of increasing net income, indicating that the company is actually having low operating costs, meaning that they spend less to provide the service or the products, and while at the same time generate more cash, more profits. And this also reflects the value of the earnings per share, which is divided by the number of shares being distributed by the company itself. So this EPS can be diluted if the company actually provide or split the shares into many more shares, meaning that for each of the shares, the earnings that they obtain or the net income they obtain is going to be diluted. So the case whereby if the company actually split their shares, it might not be a good case. However, if you're able to observe a company to have a growing profits in terms of growing net income, which actually reflecting the company business model is very healthy. Their business model is working. They will be able to have great sales, and from that sales minus all the operating costs and management fees, they will be able to still have a growing and significant amount of profits generated for their company. Next up is going to be the important part, which is free cash flow. So free cash flow simply is the cash of a company has left after paying for everything that it needs to maintain and to grow its business. So after that, the free cash flow is the amount of cash that the company can do whatever they want. They can actually distribute the dividends to their shareholders or even buy back their stocks to make their ownerships of the stock even stronger. So this buyback will allow an increase of confidence for the retail share buyers and also use the free cash flow to pay off debts as well as reinvestments to other assets or to their company in order to provide a better services or products. So with increasing and positive free cash flow, showing that the company every quarter, every year, it will be having great sales, and from that sales, it actually earn a lot of net incomes or profit. And after paying all what it needs to maintain and grow the business, and they will still have many more cash. So what you want to find is a increasing continuously growing free cash flow company whereby they will have a lot of cash power. So meaning that cash is king. So a company with a lot of free cash flow is a good company being able to show its ability to self-sustain without actually borrowing on debt, and it will actually very resilient towards any rate cuts because it has a lot of cash, and whether or not you want to have R&D as well as other investments or reinvestments, they will still being able to generate that power. The next one is going to be their low debt. So with a lot of free cash flow, if the company has more debt compared to what the company generates in terms of cash flow, it's still going to be a risky company, right? So what you want to find is that the company has low debt. So as mentioned, if they have a lot of cash, they can actually give dividends, share buybacks, as well as reinvest and grow their business. But that is only the case whereby the company has low debt. So with high debt, right, it can actually be very risky towards the rate hikes and reduce their profitability if they really have high debts, and every net income that they obtain needs to pay off the interest of the debt first before to consider as their cash flow for the company. So another indicator is actually the net cash, which I usually use to determine whether or not if a company actually has a great positions whereby I have a lot of cash and low debts. So this is the criteria that I'm looking for, which is high cash and low debt, indicating that company will be able to sustain itself in the long run without depending on the debt, which can be very risky and very dependent on the interest rates as well as, and it can actually affect the profitability and the margin of the profits obtained by the company. So moving on to the ratios, we have the ROE, return on equity. It's actually equals to net income divided by the shareholders' equity. So high ROE actually indicates a strong returns with little equity. So we'll be able to see another example of ROE of 20% actually means every single dollar or ringgit invested by the shareholders earns a 20 cents of profits per year. So it can actually misleading if you have high debt to reduce the equity and inflates the ROE. So that is why you need to combine all these criteria together to see whether or not if the company has increasing free cash flow, low debt, while at the same time having high ROE. So usually most of the analysts, me personally myself, I also use ROE needs to be consistently above 15% or consistently growing ROE, showing that the company is actually generating strong returns with just little of equity. So the higher the ROE, the stronger the returns, and with as less equity as possible. So another similar one is going to be the ROIC, return on investment capital. So it's actually how much return does the company generate for every dollar invested in its operations. So this actually can be more robust compared to ROE because it includes both the debt and the equity. So one simple example over here is that if a company earns 20% ROIC, every dollar reinvested grow to $1.2 in a year. And this means that ROIC of high value greater than 15 or to 20%, indicating that the company is actually a compounding machines, whereby for every year your invested capital of 1 ringgit will become the percentage of your ROIC. For example, over here 1 ringgit becomes 120, and in the next year the 120 can be become another 20, generates another 20%, which then reinvested to the company itself, which starts to compound the cash. And this is the strength of a company that you want to find, which is a company that will consistently generating more cash to you and is a compounding monster. One way to use the increasing ROIC that I obtained from the internet learning, I haven't actually used it, but it's quite interesting that it makes sense, is that your ROIC needs to be greater than your CC, which is the cost of capital. So meaning that if your invested return on the invested capital is actually greater than the cost of your invested capital, it's actually meaning that your return is higher than the cost, indicating that the company is actually making money. So it's pretty making sense. And also similar to ROIE, I would actually like to see a consistently ROIC that is above and increasing further away from the 15%. And lastly is going to be our white economic mode, which actually shows a unique advantage or advantage of the competitive compared to other companies and hard to copy, such as one of the company which is Apple and Nvidia, which is one of the first mover in the AI sector, high pricing power, indicating that despite a recession, right, the companies will still be able to increase the price of the product, whereby the consumer will actually willing to provide and to pay the high price in order to own the servicing. This is a good company whereby they don't actually afraid of any situation of the market, whereby they can actually increase their price in order to meet demands of their financial status, while at the same time the consumer is still willing to pay for their services. So with wide economic mode, great advantages and great services that people will actually pay more to buy their products, it should become a safe long-term compounding machines, which is why I always look at the economic mode to find whether or not if this company have wide mode, which is indicating a good quality company. So this brings us to one of few question is that to invest in strong companies, right? So once we identify a high quality company and we buy at the lows, do we actually stay forever? Well, that really depends. So that is why it is important for you to revise the data, revise the position, and to see whether or not, hey, if there's any company that emerge to have better financial status, better competitive advantage compared to your current holdings, then you might want to consider to switch your investment assets as well. So here are some of my exit strategy is that when I find better investment options. So previously during the trade wars on April, right? My Coca-Cola as well as my Altia, which is MO, they actually do pretty well during recession because for consumer staples, right, during recession, they will actually go up slightly in price because the company provides essential needs because people needs to drink, needs to smoke, although the world is actually having recession or market is having recession, right? So this kind of company will increase in price. And however, at that point of time, Amazon, Apple is at a very cheap price. The price of the share just tanks. And I was wondering, hey, I will sell my winners, which is the consumer staples, and buy the company which is actually in a cheap price. So when you have better investment options, it's actually wiser to move your money from one asset to another asset. So second one is going to be the shifting of business model. So I would exit if the company actually face a lot of problems whereby they start to lose their revenue, net income, and the company business model just not working, or they switch to another model which actually requires more time in order to grow and to extend their business model. And at that point of time, I will actually exit and to move on to another better investment. Third is going to be the money scandal. So this is one of the example whereby if the company is being reported to have money scandal issues such as the SMCI, I would definitely sell it because it's very dangerous, and for anything related about the financials, it can be making fake information about their net income, which is not reliable anymore. So the company is just, you don't know where the money is, and you don't know what is the situation that the company is in terms of being illegal or having the rights or having the needs to pay the fines, which can actually affect their business. So for money scandal, I will exit and trade my stocks and move my money to a better investments. And finally, it's going to be when I need the cash. So my rules of thumb is that although I haven't cashed out any of my stocks, is that I would want to compound all my money in the stock market and just keep on buying better investments and keep on growing my funds until the day whereby, hey, I actually need this money to buy a house or to prepare my wedding or to support my medical bills. That is where I sell some of my portions and cash out the amount that I actually need for my usage. So now we'll be looking into some of the few example and go through these criteria and factors that we just discussed and to actually observe, hey, if this is a good quality company. Over here we have the Nvidia, and as for everyone actually knows, right, Nvidia is the head of the AI sector and AI chips. So the stock has been surging since the trade war, right? It's been up almost 1x already. So if you're actually in the trade, congratulations. And we'll be looking at whether or not if Nvidia is actually a good quality company Well, I actually done this review already for my Mac 7s right during that video. And if you are interested to know more about it, you can actually look into the video of the NVIDIA. So over here we have the revenue. Firstly, it's going to be their yearly revenue, whereby it's just showing the increasing signs. So during 2019 is 11K, and going 2021 16K, going 2022 2023, and up to 2025. And for their quarterly, it's just showing the trends of increasing revenue. So first criteria is met. Second one is going to be their net income, and from here we can also observe a increasing in terms of their net income for quarterly data. Let's look at the annual value, whereby we have a slight decrease during 2020, which actually explains that because of the COVID-19, right? And during the 2021, go back to 4K, 22, 9K, 23, go back to 4K again. And for 2024, we have an insane value of 29K until today, 2025, at 72K. So second criteria is met. And for the free cash flow of the NVIDIA, from here, the annual value is actually showing an increasing trend and actually surge up to have year-over-year quarterly growth of 125% in terms of free cash flow, indicating that the company is generating more cash while at the same time having great revenues and great net income. So after looking at, hey, the company actually generating more free cash flow, we'll be looking at whether or not if their net cash is actually positive. So over here for the net cash, we have a increasing net cash, which signifying that the net cash is actually total cash minus the total debt. So in terms of positive value, meaning that they have more total cash compared to their debt. So it's actually a safe company with low debts. So another method is to determine whether or not it has a low debt is by the equity ratio. So any value that which is actually lower than 1, or you want to be more conservative, is lower than 0.5, is actually showing that the company is actually low debt. And for the ROE, we can actually observe a pretty decent ROE, always continuously staying above 15%. And starting from 2021 up until today, the value just increase, showing an increasing trends of ROE, and similar as well for the ROIC, staying above, continuously above 15%. Finally, we'll be looking at the economic mode scoring for NVIDIA, and over here we have the pricing powers, the barriers to entry, switching costs, network effects, and the scale of economic. So it's at a very decent value, 10, 9, and the final score is actually at 9.6. And also you can observe from other analysts such as the Morningstar has white mode, Look Capital also has vertical integration, so white mode, and Morgan Stanley increased their price target to 200. So actually showing that the company itself has a great and white mode with great competitive advantage compared to their other competitors in these competitive markets as well. So looking at another example, this is the last one, which is going to be Visa. So Visa has been going up pretty aggressively and just waiting for it to come back down. And let us see whether or not if this is a good company as well. Although I do remember I have done this one before, but let's go right into it. And for the revenue of Visa, we can actually observe a pretty cool trend increasing quarterly revenue of the company. And from the annual value, from here we can actually observe 22K, 21, 24, 29, 32, 35, showing an obvious trend of increasing annual revenue. So first criteria is met. For the second one is going to be their net income, and from the quarterly value is also very increasing. Just one quarter during the year of 2012 has negative net income. But overall, if you look at the annual net income starting from 2019, 12K, 10K, 12K again, and it starts to show increasing value from 2022, 14, 17, 19, and it's just increasing, very predictable growth of net income. And next one is going to be their free cash flow, whereby from here the annual value is just showing an increasing trend of in free cash flow. As for the ratios, and to see whether or not if the company has low debt, we'll be looking at the debt to equity ratio. So this one is actually above 0.5. but it's for my value is that it needs to be at least less than 1. So for 0.65, it's actually at a good level. So with a reasonable amount of debt, with at least the free cash flow is being able to cover their debt as well. So for the ROE and ROIC, we can actually observe the value is above 15%. It's continuously growing starting from 2020 up until today, which is 41%. And ROIC also growing from 2020, 15%, growing continuously being above 15% at 26%. And let's look at the net cash, which is actually the total cash minus the total debt. However, this one is actually not a pretty decent value or what I want to see, but this is quite reasonable because as we observe from the debt equity ratio, right, it's actually at 0.65, it's above 0.5, so they might have certain amount of debt, but overall, according to other information such as their revenue to ROIC, right, we can actually observe the company is actually generating money and making more in terms of how what they provide, which is the Visa cards and so on and so forth. But then this might want to be a criteria for you to determine whether or not if you want to invest in this tool. For me, this all these criteria is being met, just that this net cash to indicate that it has low debt is just within in the range whereby this company is making more cash, generating good business model, but maybe slightly higher debt, which can be one of my concerns. And I would be looking at this value to see whether or not in the recent quarters or few years later, if this value decrease, meaning that they decrease their debt instead of increasing it, then I will be having more safety in terms of holding this Visa stock assets. So I guess that is all for these two examples, right? You can actually go through many different companies, many different stocks by using this criteria, and easily you can actually disqualify a lot of stocks because once you look at the revenue and net income, it's just not showing any sign that the company is growing, it's not making money, then you can actually move on to the other one because the net income, the revenue is actually the core of this reviewing process. So that is my way to identify and to filter to see whether or not if this company is actually a high quality, a cash generating compound machine, and will become maybe in the future my investment portfolio. So it depends on the price of the stock or the company itself. So I guess that is all for today's video, and I hope you actually learn and get insights from this video. And you can actually support me by clicking the thumbs up, share this video, subscribe to my YouTube channel. Yeah, I guess I will see you on the next one. Ciao.